Hey, welcome back. In this video, we're talking all about index funds, what they are, why they're such a popular investment tool, especially for beginners, and how professionals think index funds are going to perform in 2021, what the broad market outlook is. If you're new to investing or you're just considering buying index funds this year, you're definitely going to want to watch this video. Quickly, before we jump into this, you should know that index fund investing is not a one-size-fits-all approach. There are pitfalls of index fund investing that we're going to discuss. More recently, highly successful fund managers such as Cathie Wood of ARK Invest or Michael Burry, made famous by The Big Short, have scrutinized passive investing or index fund investing, making claims that index funds are in a giant bubble and at some point it's just going to pop. So I'm just going to do my very best to relay as much information on index funds as I can, and then you'll be able to decide for yourself how you truly feel. Hey y'all, welcome back to my channel where we talk about current and relevant information on personal finance, investing, and financial planning. It's really just my goal that with the help of these videos, you would become increasingly confident in your ability to manage your current and future finances exceedingly well on your own. So if you want to stay in the know on these topics, be sure to subscribe and turn post notifications on so you don't miss a video. I'm here for you, and I truly believe that your future matters, which is why I'm making these videos. So with that, let's get into the topic of the day, index funds. Number one, what is an index fund? In the very simplest terms, an index fund is a pool. It's a way to own a group of stocks for the price of one. This is essentially how it works. We all buy shares of an index fund. With that, the index fund then pools all of our money together and goes and buys a bunch of individual company stocks. So if you just own one share of an index fund, you then pseudo-own a tiny fraction of a whole bunch of company stocks. It would otherwise be extremely expensive for you to go out and do this on your own, buy all of those stocks. So instead, buying a share of an index fund allows you to really cheaply diversify your portfolio. Oh, also just really quickly, an index fund can be comprised of stocks or bonds. We'll get into the difference between equity or stock and fixed income or bonds in another video. More technically, an index fund is a type of mutual fund or exchange traded fund, ETF. A mutual fund is an actively managed fund. If you don't know what a mutual fund or ETF is, go quickly watch this video and it simply explains their definitions. What is an index? Well, it is simply a list of stocks that comprise a segment of the financial market. Examples of popular indices are the S&P 500 index, which is comprised of the largest 500 publicly traded companies in the US, or a total stock market index, which is going to track thousands of companies representing the total stock market. There are indices that track almost every subset of the market you can think of: tech stocks, semiconductors, real estate, healthcare, consumer staples, energy, airlines, you name it. So if you really wanted to own stock in the airline industry, you could buy the ETF called JETS, which tracks the US Global JETS Index. This index tracks the stocks of airlines, aircraft manufacturers, terminal services, airports, etc. And instead of buying the stocks of all of these companies, you could just buy one share of JETS. So an index fund then buys the stocks of every company that is listed in the index it is designed to track. An index fund should just exactly mirror the performance of the index as a whole. So that's why you can see multiple S&P 500 index funds from Fidelity, Schwab, Vanguard, etc. They all just track the same index, the S&P 500 index. And then all of the funds should pretty much have the exact same return. Indices are commonly weighted based on the market capitalization of the companies within the index. So that means that as of January 9th, only the top 10 stocks within the S&P 500 comprised 27% of its total holdings because they're so large based on market cap. So let's move on to point number 2, because this is what really matters for you. Why are index funds so popular, especially for beginners? Well, quite simply, index funds are really cheap. They're an easy way to diversify your portfolio and to lower your overall portfolio risk. They also require little to no effort on the part of the investor. They're highly tax efficient because you can just buy and hold for a really long time. And they're a fantastic way to capture long runs in the stock market, like 10 10, 20, 30 plus years. The reason index funds are so cheap is because they're passively managed funds. This means, as opposed to a mutual fund, there isn't a portfolio manager actively strategizing which stocks to buy and sell and package together in the fund to deliver to someone. Rather, the holdings in an index fund just automatically track its benchmark index. Thanks to technology, stuff like that can be totally automated. Rebalancing an index fund, buying and selling the stocks is just completely automated. So that's why, as a result, index funds have very low operating expenses, and thus very low fees for investors, yourselves. Fidelity has even put out some index funds with 0% expense ratios. FZILX, FZROX, and their 500 index fund has an expense ratio of 0.015%. That's essentially free. So rather than buying individual company stocks, index funds offer a really low-cost diversification option to investors. It allows you to own many more stocks for just a fraction of the price. And holding an index fund hopefully lowers your overall risk, because if one company in the index is seeing negative returns, hopefully a lot of the other companies will offset this. What's interesting though is now a lot of online brokers such as Schwab, Fidelity, and Robinhood offer what's called fractional shares. This means you can just purchase a piece of a company stock for a fraction of the price and essentially create your own personal mutual fund a lot easier. Anyway, back to index funds. They're super easy to buy and sell through online brokerages. If you're new and you don't have a brokerage account yet, my suggested brokerage is Schwab. No promo, I use it and I love it. What makes index fund investing so convenient is you can simply buy it and hold it for a really long time. In doing this, you're simply believing in the trend of the market, which since inception has been upward. Yes, the market ebbs and flows around the trend line, which is generally upward. If you would like to better understand this, check this video out. I will link the timestamp in the description below that explains what the general trend has been since inception of the S&P 500 index. All right, so point number 3, let's get into the 2021 outlook, which is really important if you're thinking about buying or selling index funds this year. In all of my research, I believe that analysts are largely bullish, which means expectant to do well. Bearish means expected to not do well. I believe that analysts are largely bullish on the broad stock market through 2021. This includes the S&P 500 index. If you follow ARK Invest, Cathie Wood, CEO and CIO, said that she predicts earnings per share of the S&P 500 will be 200, up from 100 last year. This was in January, but it's subject to change month to month. I believe that there are a lot of factors that will continue to drive strong gains throughout the first half of 2021. This includes broader vaccine distribution, a unified Congress with the prospect of additional stimulus, and a Federal Reserve that is committed to accommodating economic recovery. That means likely keeping rates low through 2021, which perpetuates a rally in the stock market. If you don't understand why, it's because when rates are low, it's hard to make money on a lot of other assets besides stocks. So that drives activity in the stock market. So looking through some research, we can see how many analysts and professionals think there's going to continue to be a rally in the stock market through the first half of 2021. Price targets are still high, confidence is high, and individual investors are continuing to plow money into the stock market. All right, so let's just look at some of the headlines that kind of summarize where analysts think the market is going to go in 2021. Headlines like this: stock market pros are having a tough time imagining an S&P 500 slump in 2021, pretty much summarize where analysts are at right now. Majority of this information is as of the end of FY20, and analysts usually update their forecasts quarterly, so stay tuned for quarterly updates throughout the year. But as of now, it's looking like the US stock market is onward and upward throughout 2021. Analysts are estimating year-end gains and quote-unquote eye-popping rallies throughout the coming months. A majority of analysts expect an 8 to 22% upside for the S&P 500 in 2021. Again, this was as of the start of the year, so we'll see how their forecasts change each quarter. As we mentioned before, this is because of the reopening of the economy, vaccines, additional stimulus, low interest rates, etc. So you can look at what the top Wall Street banks are expecting. If you look at this list here, Goldman, JPM all have price targets above 4,000. These were their S&P 500 price targets at the beginning of FY21 when the S&P 500 was closer to 3,700 points. Now, just looking at this, it's currently around 3,900 points, so we've already seen an increase. So even though the market is at all-time highs and it seems like how could this continue to go up, waiting for a pullback could prove to be a mistake in the first half of 2021 because we're still expecting to see gains. And Goldman even says even though there's a growing risk of correction, it's not quite time to jump ship yet, and even though there's going to be near-term volatility, analysts are still expecting near-term gains. That being said, there is reason to believe that there will be a huge market correction at some point in 2021, in 2022, or beyond. We don't know. But a lot of company valuations have skyrocketed to seemingly absurd levels, and analysts believe at some point this has to revert and correct itself. So we have sources like this that say that a stock market correction could be coming soon because government spending, central bank aid can't get much larger than it already has gotten. This article was really interesting. It talked about the cyclically adjusted price to earnings ratio of the S&P 500 and how it's currently at almost 35 times, which is more than double its historic average. And this article talks about how historically when the PE ratio gets this high, market corrections have to happen and bad things have happened, especially in the crash of '01 when valuations had just gotten way too high like they kind of are in this day and age. You guys, I think it's so fascinating. I was just reading an article on Blink charging the other day. I'll link it in the description below. But it basically explains how a company with less than $1 million in quarterly sales, not operating income, sales, has a multi-billion-dollar valuation right now, and the stock price just continues to go up without even a proved business model. All right, you guys, I just have to take you through this for a second because it's really important to understand, and it also helps explain why we're potentially in a stock market bubble and why a lot of company stocks are way too highly valued and need to correct downward at some point. So looking at this company has not posted an annual profit in its 11-year history. It was on the verge of bankruptcy a couple of months ago. The only reason it hasn't gone bankrupt is because the stock price skyrocketed because people got so excited about the buzz around electric vehicle companies and the stock started trading, which then made the company able to go issue shares at that stock price and get a lot of funding, $230 million to be exact, and that's keeping them alive. But the thing about this, you guys, is it's truly market euphoria. If you look at how the company is actually suited against its competitors, it only has a 3% market share in the current electric vehicle charging network. There's also been a lot of executive turnover. There's a lot of reasons why this company isn't suited to have a multi-billion-dollar valuation at the moment, but that's not to say that in the future, potentially it might gain more market share, and as utilization of electric vehicles goes up, their charging will become a lot more profitable. It'll be interesting to watch this company over the next couple of years as electric vehicles starts to take off and see how they really end up doing. All right, so I might have got a little bit sidetracked explaining what's currently going on in the market with companies like this, but this actually really helps explain what's going on with index funds as well and why people think they're in a giant bubble. It has to do with smaller companies that shouldn't potentially be getting the funding that they're getting who are part of index funds, having their stock price artificially inflated by being a part of the index fund like the total stock market, Russell 3000, etc. And because people are buying these broad market funds, they're inadvertently buying these shares in these companies, which allows the share price to go up, which allows these companies to be able to issue shares in the market and get more funding that ultimately you could argue they don't deserve. So it's creating a vicious cycle and circle where companies that are underperformers are actually getting funding that they shouldn't be getting, and at some point it just has to implode and correct. In short, that's Michael Burry's argument. We'll get into that in a totally different video that explains why index funds could be in a bubble and what could cause them to pop, but that's a quick synopsis for now. Let's move on. So for the sake of time, I think it makes sense to save the pitfalls of index fund investing for another video. I'll take you through why professionals think that index funds are in a giant bubble and what could potentially cause it to pop. It almost seems like index funds are too good to be true, and is that really the case? Well, we'll dive into it and hopefully you'll be able to decide for yourself. If you've never heard of ARK Invest and their ETFs, you should look into it and their investment strategy. I think it's just really helpful, and I personally love Cathie Wood's investment strategy. She talks about why active investing is so much more important than passive investing. investing. In passive investing, you're missing out on a lot of the growth trends, the new opportunities that you should be following and seeking that are actually going to continue to have really high return in the future and not become obsolete. If you're buying a total stock market index, you're potentially owning a lot of companies that are going to be irrelevant in the next few years, and you could potentially be better off if you followed more innovative funds like ARK-K, ARK-W, ARK-G, ARK-Q. These are ETFs and they're actively managed ETFs, which means the ARK investment team is actively strategizing which stocks to buy and sell and when. Anyway, that was information overload, but I hope it was able to help you understand a little bit about index funds, why they're so popular. If you have any questions outstanding, write them in the comment section below and I'll get back to you. Comment below if you're buying any index funds. I love you guys. I'm so glad that you're here on this journey with me. And as always, I hope that you have a wonderful day.